What's up, guys? Welcome back to another episode. And this week I have to deal with an article that I saw in the Irish Times, and it's one that really grabbed my attention. And I'm sure anyone who is thinking about buying a house, renting a house, becoming a landlord, whatever it might mean regarding purchasing a property in Ireland, this is going to stand out and it's going to catch your attention. Now, it began with an article that I read in the Irish Times, and the article was, I think I saw it on Thursday, but it was standing out very clearly. Irish house prices are overvalued by 10%, says think tank. Now, the think tank that they're referring to is the ESRI. And the ESRI is the Economic Social Research Institute. And it's been around since the 1960s. And what I want to do is just get into the findings of this and to analyze, is it actually true? Because there's a lot of ramifications if it is true. And so I do think this is an important discussion. Could it really be the case that we're already overpriced and that we're all buying away? And certainly having the coaching conversations that I'm having with my clients in the accelerator, a lot of them are of the view it's very, very difficult to find value. And if you're finding it very difficult to find value, well then I guess that kind of points to the market being overvalued. In general, we'll say that if you're looking at the average person looking at houses for sale in the paper or online, if everything you look at looks overvalued, well then it goes to the point that it must be overvalued if you can't find a deal. Now that's not to say that you won't find a deal every now and then. I know one of my coaching clients, Jonathan, just recently told us that he had bought something online. He'd been on BidX1 and he saw a property that he was interested in. He put his name into the system, registered and everything like that, and he was expecting to have to kind of bid against a couple of other people on this property, and there was no other bidders. And so he secured that property, and in fact he's just closed on it in the last couple of days. And he's going to do well out of that. So it's not impossible that you'll go out and you'll find a bargain. But what we want to get into is the general sort of property price that's out there now. The prevailing property prices, no matter where you are in the market, are they 10% overvalued or not? And it's, I think the best way to, we have to unpack this. Is this a bold claim? Or is this a reasonable claim? I think we have to think about that. We have to look at how the ESRI came to this conclusion in the first place. I mean, it's fine going and putting out a statement like that, but when you actually dig into it, how did they analyze the details and the data in order to figure that one out? And what would it mean to the Irish housing market if that were true? How does it compare to the devastating crash of 2008 that many of you will remember, and many of you will have wounds and scars left over from that? And I'm also going to reflect on the ESRI's track record. In the past they've been spot on, but also they have underestimated and overestimated things. So we need to go into that. So I'm going to kick off the episode with a quick reminder that my accelerator, the January intake, is currently open. I've had a couple of people sign up now, and I'm hoping that you're listening here and you're thinking, geez, yeah, I'd love to kick off the new year with a new focus on my finances and all that. And exactly what we're talking about here today, whether house prices are overvalued and all that, that is a key part of your property investment understanding. If you cannot assess a property and assess whether or not it makes for good value, whether you can foresee an exit, what is your exit going to be, how are you going to do that, all of that stuff is very, very important to be able to achieve. And also, if we are in some sort of, if as we're going to explore today, if prices were 10% over and it were to trigger some sort of a correction in the market, which is what is implied here, then how would you know when it's a good time to get back into the market? Like, all of that is part of the of what we teach inside of the accelerator. So anyway, guys, let me know if that's of interest. Vastly outnumbering most people there's people from a construction background. So if you're listening to this, if you're a contractor, subcontractor, working in the construction industry as a professional, supplier, whatever it is, there's a lot of guys like you in the accelerator, all wanting to know how to apply those skills that you already have and turn it into some sort of means of creating passive income, so you don't need to work right up till the end. Anyway, let's get back to the episode. Who are the ESRI? It's funny, I used to always wonder when I heard the term in America, think tank, and they talk about these think tanks. What a think tank is, it's these institutes that have been put together. They're not really profit-making organizations. They're more there to just put out research. Now, they're supported through membership and various things like that, but the Economic and Social Research Institute, the ESRI, was founded in the 1960s to provide independent, evidence-based research on the Irish economy. It's a respected institution that informs both public policy and private decision-making. So that's what ChatGPT said to me about the ESRI. Now, the big thing that you got to sort of focus on in these things is it actually independent? Do they have an axe to grind somewhere, or is there somebody paying their fees that is wanting a certain narrative to be going out there? And that's always an important thing to think about, is who is giving you the data? Like, if I was to say that house prices are massively undervalued, and and by the way, I'm in the process of selling some houses in this location over here, I'm clearly biased towards trying to sell. So where is your information coming from? You have to look at that in the cold light of day. Certain people are going to tell you something that have a preferred narrative. The ESRI is trusted in its commitment to unbiased research. It doesn't take political stances, and it is funded by a mix of public and private sources. So that stands out as a good thing, I guess, because what you'd always be wondering are these guys providing a narrative that is designed to kind of like back up the government, for example? Or are they designing a narrative that has been, prompted by opposition parties, talking points and stuff? We want to make sure that whatever we're talking about here, that it's research-based and that it's independent and that there's nobody trying to swing it in a certain direction. Having said all that, it doesn't mean that it's absolutely infallible. They could be making mistakes in their assumptions, but at least it's coming from an honest place. Now, there's another area we need to focus on. The ESRI tackles critical areas like housing, labour markets, public finances, and economic sustainability. So when they make a statement about the housing market, people do tend to listen. It is an important organisation. But let's get into how this was researched. This research was conducted. Now, there was 2 reports issued or published in the last couple of weeks, or in the last week even. And the first one was a special report. So it's actually, I just went in and downloaded it there. It's completely for free. If you go into the esri.ie website, they have an ESRI special article assessing expectations of European house prices. And it's a long article, like there's, I don't know how many pages on it, but these things, it's not a quick scan and you've read the thing. It's like 100 plus pages in these things. And so going down through it, this formed part of a quarterly economic commentary for the winter of 2024, which went out. And going down through it, like what they say is, this research report on house prices is based on rigorous analysis. That is according to ChatGPT's summarization of the report. The ESRI examined consumer expectations for house prices and linked them to economic fundamentals like income levels, mortgage interest rates, and housing supply. Now, this is across Europe. This was done across Europe, and Ireland was included in the mix. Some of the data sources, they used surveys from the European Central Bank, and they used real-world data from Eurostat to understand the dynamics behind the Irish housing market. And if you look into that 10% figure that they've used, like in their conclusion, house prices in Ireland are overvalued by 10%. This means that based on economic fundamentals, property prices are priced higher than what most people can afford. And I think that's a really important thing to drill into there. They are not stating categorically that house prices are 10% overvalued. What they are pointing to is that if you look at it in the European context, then it would look like Irish people are having to go and take out mortgages that they cannot afford, or that comparatively to the European sort of comparisons, you cannot afford. And so I don't know, I haven't drilled into enough detail to know, like, but if you're taking out a mortgage and it represents like 60% of all of your income, every interest payment that you have to make every month, like that's a really heavy interest payment and a heavy commitment, considering that these things are usually, 20-year mortgage or whatever. Now, obviously, you'll see your pay increase over time, but for 12 months, you'll be paying this rate, and you're just hoping to God that your interest rates are going to fall so that the rate will become more affordable as you go on. Now, I got a message from my a direct message from somebody in Instagram in the last couple of days, and they were kind of in a difficult position. I won't give too much detail, but they just sort of say, my situation is I own a couple of investment properties, and then my mortgage was with I think it was the permanent TSB, and it has been moved now to Mars Capital, I think it was. And they were saying that now the new payments that they're having to make equate to 12,000 a month, and that is across all of the properties. But that's the mortgage. Originally, they took out an interest-only mortgage, and now that they're in Mars Capital, it's interest and capital, and it's 12,000 a month. And I was just kind of thinking, how do people end up in this position where they're having to pay that kind of sum? How much are you collecting from the property itself? And I think it was something close to like half that. And I was just thinking, part of the problem here is that people are not educated enough when they're buying. Like if you're buying a property and it's yielding 5%, and you're taking out a mortgage and the mortgage is 5%, you might kind of think to yourself, okay, grand, one is washing out the other. Well, it's not exactly, because you don't just pay interest-only mortgages, you pay interest and capital. And so the mortgage interest is only a portion, and then the capital is the other side. So if you're paying 5% and you have a 5% interest mortgage, if you're collecting 5% of rental income, you're not matching one. All you're doing is matching the interest rate. You're not matching the capital payments. And then don't forget, you've also got to pay tax. And so this thing, a lot of people just don't have the financial sophistication to actually do those maths and figure it out. And they think to themselves, well, look, I'll increase the value of the property and this will get me out of trouble. But it'll only get you out of trouble if you sell it. If you're buying it to hold it as an investment, then it's not going to serve you very well. Anyway, the bottom line is, people are buying property in Ireland, and because of the prices that are there, the mortgage that they're taking out are, compared to the European comparisons, they just seem to be over stretching themselves. And it's important to point that out. Now, where in the past have the ESRI gotten things right? We have to give credit where credit is due. They have made some accurate predictions in the past. They did predict that there would be this post-pandemic recovery, and they expected strong rebound in Ireland's economy in 2024 and 2025, which has happened to be the case, including like job growth and declining unemployment rates. So they were spot on this, and so credit where credit's due. They also correctly predicted the resilience in Ireland's labour market despite global economic uncertainties. So there was a lot of stuff going on around the world with China and things like that. The Chinese economy is in a pretty bad way at the moment, and yet our economic growth continues. So that much is good. One of the things they warn about, though, or they certainly have expressed concern about, is just, will Donald Trump being in the White House next year, will his policies start to hurt Ireland? We have a lot of foreign direct investment coming from US companies. Will that stop? We'll have to wait and see. The ESRI also got wrong a few things. Predictions they got wrong. If you go back to the Celtic Tiger, pre-2008, in the mid-2000s, they underestimated the scale of the property bubble. Now, they acknowledged there was a risk of a crash because of the way people were speculating, and there was credit and all that kind of stuff. Nobody saw how bad it was going to get. And so they did not foresee the catastrophic crash that it turned out to be. And also more recently, their population projections have been underestimated. They did not see the rapid growth in Ireland's population. The 2022 census revealed population of over 5.1, which far surpassed previous estimates. And so this has had a significant impact on housing demand. Like, the fact that our population is growing at the rate that it's growing is putting huge pressure on the housing demand. So what are the overall implications if we are in a situation with overvaluation? For starters, it signals a potential housing bubble, which anyone who's old enough to remember 2005, 2006, you kind of think to yourself, oh, it's only ever going to go up, and so just got to get in the market because I want to ride this, this wave. And we all felt like that back in 2005, 2006. Like, people felt pressure to get into the market so that they didn't have to buy at a later date at a much higher price. They wanted to get in while the prices were going crazy. And it's not long ago people had that same feeling in the whole crypto space. Notwithstanding now the fact that Bitcoin has gone over 100,000, but there was a lot of people buying these coins that are kind of no longer exist and stuff. And there was this sense of, oh my God, I got to get into the crypto market. And some people just got into the wrong investment and it went completely to hell. So you've got to be very, very careful where you put your money. And the ripple effect, what we got to be careful of here is if we were into a housing bubble and if it was to burst, then prices could, if our income stagnates, if we're not earning money quicker, if we're not getting pay rises that are higher at the end of each year, and yet house prices continue to go up, well, then there's going to be a stagnation. And it's going to be a point where you just simply cannot afford to buy property because your salary will not support the mortgage that you need. And in that case, there's various things that builders can do. Obviously, what you have at the moment is there's the grants, the first-time buyers grants and stuff. They are actually supporting some of the houses that are being put on the market, because you've got people there saying, sure, I'll just raise the minimum amount of deposit, and then I'm going to get this support from the government. And that is certainly helping things. But it's going to become less and less possible to do that over time. It puts pressure on the rental market. If people cannot afford to buy, then they're just going to have to rent for longer. And at the moment, we all know the rental market is absolutely rammed. And it's also being made less popular by various taxation things, that the rules that are being brought in, the RTB, the rent pressure zones, all of this. And so that's going to create this situation where people want to get out of being a landlord because there's so much restriction. And so there'll be less property on the market for rent. And if there's less property on the market for rent, what's it going to do? It's just going to push up rental prices. So you're going to be on the one hand, you've got to buy property and the house prices are very high. On the other, you've got to rent and the rental is very high. So I don't see a situation here where it becomes easier. If house prices were reduced by 10%, let's say, you might sort of say, okay, great, now we're not paying over the odds. But I think the reality is that if the house prices were to drop by 10% next week, or even let's say 20%, is that going to make it easier for you to afford a house? No, I don't think so, because I think the reality is there's 50,000 people out there chasing maybe 1,000 houses for sale. And so the demand is massive. And you have a situation where, okay, let's say if the government just automatically waved a magic wand and said, house prices are now magically 20% lower. That price, that house that you were going to buy for 400 grand, it is now 320 grand by mandate of the government. That's fine. Now, I suppose all of a sudden you've got 10,000 people that can afford 400,000, and now obviously it's even easier to afford 320,000. Do you think those 10,000 people are all going to buy the same property. Like, there's only one property available at that price. You've got a lot of people chasing it. So there's only going to be one survivor in a bidding war. So you're going to have a situation where 10 people bidding on the same property that they can afford because it's now 320. Everyone bidding, prices get bid up to where? To 400 probably. And so this is the thing that I think people are missing when they come up with these points. So the overall impact as well on construction, if there is a kind of passing narrative around the market that prices could crash, that there's a housing bubble here, I don't think it's going to help our decision that we want to have more property built, because developers who went through 2008 are going to suddenly go, whoa, wait, we gotta factor in a possible crash here. So maybe we don't start development. Maybe we try to pre-sell all of these properties to the big funds, because the big funds will guarantee us that we'll get our money at the end of the project. Whereas if we wait till the end of the project and then put them on the market, and the house prices are, just out there and there's people kind of bidding on them based on the market value, then you might suddenly say that's a risk I don't want to run. And so I think I'm just going to try and sell to a housing body, or I'm going to try and sell to a fund. And so you're going to get into more of those kind of situations where developers will be running for cover. Comparisons to the 2008 crash, like the last time we saw significant overvaluation of housing property was during the Celtic Tiger years. Back then, over-leveraged mortgages and speculative buying led to this collapse. And it was a catastrophic collapse because it had just gone so crazy over. But nobody that was buying at the time was buying because they had a real need for housing. They were buying because they were speculating that the house prices were going to continue to going up. Today, mortgage lending is much, much more tightly regulated. I mean, think about the amount of people out there that have been turned down for mortgages because they don't tick the box for the it was 3.5 times your earnings, and then it was marginally increased to 4 times. Like, we're not seeing the same level of speculation out there that had before. And I can talk to that because I was one of those speculators, and I can remember so easy to get money. If I wanted to buy something, I just simply had to ring up the bank and say, I'm going to go after this property XYZ. Will you make the funds available to me? I've got no money in the bank, but they would say, yeah, that's no problem. We'll, if you can pay up to 400,000 for that, we'll cover you. And then I would go and I would make arrangements with the bank to kind of like secure some other asset that I had where there was equity in it. And that's how it was worked back there. So it was very, very reckless at the time. And, that's not what we're looking at today. The banks are really, really cautious. And so I really do not think that the mortgages that are being lent out there are being lent out really willy-nilly to the point where there could be some sort of a crash because of, crazy mortgage practices. But however, rising mortgage to income ratios are a concern. There's no doubt like that people are having to put a huge amount of their spare, their after-tax earnings into their mortgage. And that does create something of a pre-2008 trend. And you have to kind of be wary of that. And if you look at how Ireland compares with the rest of the EU, the ESRI's findings, they show that Ireland's housing market is uniquely pressured. That's the word that they use. While other European countries face similar issues with affordability, Ireland has the added worsening of this supply-demand imbalance. It's like far more acute. We just cannot build enough houses. We're online this year for 33,000. And we need to be doing, according to the ESRI, 52,000 or 50,000. So we're like so far short that it's nearly 50% short. And if you go and have a look at what they're expecting next year to hit, which will be a bonanza year in the housing industry, 40,000. 40,000 is still 10,000 short. So nobody's patting in the back and saying, well done, lads, you did it. It's like, you're still 10,000 short. So all of this is just pushing Ireland into this very, very unique place where it's just absolutely out on its own in terms of the pressure that the housing market is under. For example, in countries like Germany and France, the housing supply has actually kept pace with demand to a greater extent. but Ireland just consistently lags behind. Now, if we think about just the demand that is unsatisfied, that's the bit where I kind of think that it's hard to, you might be able to theoretically argue that we're 10% overvalued based on, say, mortgages and stuff. But does that mean it's going to stop now and it's going to, reverse? Really, I don't think so, because of what I said earlier. It's just, there are 33,000 homes being built in 2024, and we have a demand for, say, 50,000 houses. So every single house that was going to be bought already has a buyer, plus another one buyer that was disappointed. So what does that person do? That person goes off and looks for another one. And I think the number of disappointed buyers out there, I think Davies Stockbrokers came up with a number a little while back, and it was 212,000 people in the market chasing after property. And our population continues to grow by about 50,000 a year, and yet we're only doing 33,000. So you've got the pool that are looking for property, and you have the new people coming in that are also looking for property. So this kind of shortfall just creates pent-up demand, and it's going to keep on pushing prices. And as I said, that example earlier, the government were to come in and say, right, everybody, you're getting a house price holiday, bang, everything is cut by 20%, a Black Friday sale on house prices across the country. Every property now 20% lower. What's that going to do? Does that solve everyone's problems? No, because there's still not enough houses for the people that want them. And so naturally, when you go and put all everyone's going to want if you're putting a house on the market at 320,000 and you have 5 bidders for it, then what would happen? One bidder says, well, look, I'll give you 321. And then the other one says, well, sure, I can afford 322. And then somebody else will say, well, I can afford 323. And it just goes on. And it's who wants the house bad enough? What are your alternatives? Can you go off and rent? No. Do you have another home to move into? Well, that's different. If you own a home already, then you're sorted. But if that option is stay living with your parents, maybe that's fine when you're a single person. But what about when you get married? Then all of a sudden it's well, I don't want to move in with my husband, or I don't want to move in with my wife's parents. I want us to live on our own. So let's find a place together. And if you have kids, that even multiplies, because I can tell you, grandparents love to see their grandchildren, but they also look forward to when they leave the house that afternoon, when they can get back to peace and quiet, because kids are hard work, especially young kids. So for those who cannot afford to buy or rent, the options get really, really limited. And the government has brought in a policy that said that, bedsits were no longer permitted. And so they're removed from the market. They were an option for a while, but they're no longer an option. Amazing to me, the government decided to bring in a ban on co-living. Co-living was actually, I thought, was fantastic. Co-living was a little bit like going back to being in dorms in college. You had your room, you shared a kitchen and a kind of living space with a bunch of other people, but you had your own room. A lot of the time you had your own shower, and you had your own desk where you could do your study and stuff like that. And for a lot of people, they actually quite like that environment in college, where you're able to go off and close the door and have your own time, but you can also go out, you can mingle with your pals and stuff. And then when you're in that, youthful college kind of mindset, that's great. And when people get their degree and they get this piece of paper that says you're now qualified, they don't just switch their brain and say, right, now I'm a working person, I'm going to go and buy a house. They're like, well, I actually kind of like that lifestyle. I want to go and so co-living provided that. So I think co-living is a possible solution, but seems like a lot of people are just, not going to have that, certainly in the Irish market. So what are your alternative? Being forced to live with your parents longer. Not really viable long-term, although it is happening long-term. People are into their 30s and stuff. I moved out of home at 21 years old, and my brother was a bit more of a homeboy, and he moved out at 24, I think. And so, give you an idea, just this is the way it goes. The only other alternative after that is really emigration. Is just, I'm going to go abroad, and I'm going to go somewhere where I can find accommodation that's not so, doesn't take up such a huge percentage of my income. And those are maybe your options. Now, Where do you go? Probably people are going to go to the likes of Australia, or they're going to go to America or something like that. A lot of people will not go to the, well, if you're looking for a traditional job, you're probably going to want to go to the US or Canada or Australia or something like that. If you are in the modern economy where you can actually start a business and you can sell online using Instagram and all this kind of stuff, which I've started doing, and I can see how effective it can be. I'm starting to think that, okay, in that situation, if you're good at what you do, if you know what if you've got these skills, then it's quite possible that you could actually go and say, right, I am going to move to the south of Spain, or I'm going to move to Dubai, and I'm going to live in this climate, nice climate. Yes, maybe the cost of living and stuff like that may be higher, but I can afford it, and I don't pay as much tax, and I'm going to do this until I've built up a bit of a nest egg, and then I'll have property, and I can, if I want, I can go back home, I can buy, and I can settle down, and I can be closer to family. And that is a consideration when people have children, because when you have kids, all of a sudden the consideration is, I need some form of childcare, and a lot of the time having sisters and nieces and grannies that can kind of help out, that happens to be a lot of people will actually push for that kind of thing. They'll think to themselves, if I'm near home, I can at least drop the baby off and with granny for 2 hours, and I can go off and I can go to a medical appointment or something like that, rather than bringing the baby with them. You don't have that option when you live abroad. And so maybe you can have a nanny or something like that, but it depends on your income level. So those are the things. This is where it becomes a bit of a problem, is that as house prices continue to get further and further away from the ability of you to get a mortgage, that's going to be problematic. Now, the other thing that I see coming down the stream is that interest rates are dropping. And if you look at the 5-year swap rates for interest rates in Europe, 5 years from now, they're predicting that they're going to be around 1.5%. And so that's going to be nice and low. Like 1.5% mortgage, it's going to be good. But the thing is it's a couple of years away, so we're going to have to get down there. But what I do know is that drop of interest rate numbers is going to probably push house prices up even more. Because anytime that happens, by the way, this week we had another interest rate drop by the ECB. And so it's following a pattern. We've seen this happening for the last few months. We kind of knew that was the next move, was another drop. So it's happened. And so it is on course for 1.5%. So if you say 2 or 3 years from now, you'll be back at really nice low interest rates. But the reality is it'll push up house prices, because the monthly payment will be much more affordable. And so you can afford to get in and borrow that little bit more. And that's all fine as long as they maintain that lower rate. But if there is another inflation blip, if something happens, whether it's some sort of a conflict between nations or whatever it might be, or some sort of an artificial intelligence kind of a boom, or whatever could trigger some sort of an inflation, all of a sudden, to combat that, they put interest rates back up. So you would worry that you've taken on a mortgage based on those lower rates, and it could creep back up. That's the question we have to have. Some people are of the view that low, like technology, like AI, all of this stuff, that is deflationary, and that as long as there's technological advances and innovation and stuff, then what we will see is continued low inflation, in which case we can start getting used to these lower interest rates being kind of a fixed thing. Fingers crossed that's the case. But we shall see. What are the alternatives for those who cannot buy or rent? As I said, it's, co-living perhaps, micro apartments. This is what we've actually seen in Japan and stuff like that. We've seen where literally tiny things, but, Ireland banned the co-living, and it banned bedsits. And I think bedsits would be considered micro apartments, essentially. So these are not long-term solutions. And then somebody else said to me the other day that, well, what about with these conflicts like the war between Ukraine and Russia? That is possibly going to come to an end with Trump in power. If that's the case, then a lot of the Ukrainians, the supports that they have will be removed and they'll be asked to go back to Ukraine. And so that'll free up a lot of accommodation. And somebody said, this is going to mean thousands of, units are going to be back on the market. But if you think about it, if you analyze that a little bit more carefully, like where are all of the people that are staying in, like if you look at Ukrainian refugees that were housed and stuff, in a lot of cases they were housed in hotels, in bed and breakfasts, in factory buildings that have got makeshift kind of rooms created and all this kind of stuff. You've got people that are renting out their front room and the room to rent kind of scheme, and you've got the ARP scheme that people have, that they'd be getting €800 a month. All of that will come to an end at some point, but that is not going to free up houses for the market. What that will do is it'll house up accommodation, beds, and it'll free up maybe hotels and things like that, and there may be less of a bonanza for the guys that are in that housing space. But I don't think it's going to free up tens of thousands of houses that people will be able to buy and start families in. So we'll have to see whether that's a solution. The risk of homelessness is increasing, and there's a lot more people that are homeless now than were ever the case. And I heard during the week that one of these charitable places that hands out lunches or packages, food packages or something like that, that they actually ran out much, much sooner than before for the first time. And so that's another issue that's going to be something the government has to tackle. I was on Grafton Street yesterday. It was my daughter's birthday, and we brought her to a restaurant for a bit of a day out. And afterwards, we were walking up, and we were walking by this new development, or relatively new development, and it's on Clarendon Street there, and it's got all these fancy watch companies. So you've got Hublot, and you've got Breitling, and you've got Cartier, and you've got all the top name brands and stuff, and real fancy. And I was looking at it, it felt like being in London, like on Bond Street or something. And across on the other side of the street, there was a guy or two people in sleeping bags, asleep, like middle of the day, just asleep on the street. And I was thinking to myself, wow, like it's kind of glaring when you have these watches worth 20,000 and 30,000 and 40,000, and then across the street you have guys sleeping rough in a sleeping bag. So that homelessness stuff is a problem. Closing thoughts. Listen, this has dragged on a little bit. I didn't expect this was to be like 40 minutes. The ESRI prediction of 10% overvaluation is certainly a wake-up call. I think there's an element of truth to it insofar as the mortgage affordability, for sure. But you got to ask yourself the question when it comes to, is that just because you are more costly than is affordable from a mortgage payment point of view, does that mean that house prices are going to collapse? I don't think so, because I think the demand is too big. But it does highlight deep structural challenge in the housing market, which we've been aware of for a long time. And so, the supply shortage is just going to create this ongoing affordability crisis. The ESRI has been right about many things, but they have missed the mark a few times. And in 2008, the severity of the crash, they underpredicted that. Is that one of these situations now where they're underpredicting, or is it a situation where they've overestimated? We'll have to wait and see. But you've got to I guess you just got to read it and pay attention to it. And just like all of the guys that are in my accelerator, we look at deals and we're looking for affordability, and we're saying, we're looking at 100 properties, let's say, and if 4 of them are worthy of a really close look, that's about the percentage we're talking about. We're not looking at 100 properties and bidding on all 100, because most of them are already massively overpriced before you even start. But if you can analyse the 100 properties and whittle it down to 4 that look like there could be a nice return to be made on this property, that it's underpriced, and maybe it's underpriced because there's some aspect of it that you can add value to that nobody else can see that opportunity, all things that we talk about in the accelerator. If that's the case, then you go for it. But there is by no means a situation where you just throw darts at a board and whatever it hits, that's a winning property deal. So what do you guys think? Would love to know if you have experienced the effect of house prices or rents lately, like, is it all completely unaffordable? Have you found any deals? Are you finding any of the bargains? Like my friend in the course found the property recently, bid X1, only bidder, thought he was going to be in a fight and just took it off the market at a nice, just basically at the asking, and was delighted with himself, and knows that he's going to make a nice turn on that. And so there's a good example. So let us know, guys. As always, you can go and connect with me, Gavin J. Gallagher, on Instagram. And by the way, I've mentioned it maybe once before in the past while, but I now have this new little app called Buy Me a Coffee. And if you guys are finding these podcasts of any value or use to you and you want to buy me a coffee, you go click the link in the show notes and it gives you an option to go and buy me a coffee. So guys, wishing you a great final week before the Christmas madness. And today is the 15th as I'm recording this, so 10 days to Christmas. Look forward to catching up with you next week. Take care.